The broadcast is now starting. All attendees are in listen-only mode.
Hello there, everybody. How are you doing today? Hey there, Ronald. Awesome. Fantastic. Well, I hope everybody has had a good week trading so far. Last 2 weeks have been really crazy with the China news, earnings, and the Brexit stuff, and coming back out and all that. So, but hopefully you've been surviving through it all and doing well. So I'm doing fantastic. Thank you for asking. Awesome. Well, now that we know that everybody is on and getting going, let's go ahead and get started. And of course, the topic of tonight, as you know, is the CME micro futures that have recently been released. And, I've seen a lot of questions come in. We sort of let some of the common questions come through before we did the webinar on it. Wanted to see where everybody was at. And we want to talk about, what you need to know to trade them effectively, right? So, because there's some things that you really need to be aware of. And then there's also some stuff that, just the basics that some of y'all may not know. And, I want to remind y'all as far as, ways to trade them and how to learn, if you want to take your trading to the next level, go ahead and hop on. And, we got training. We have trading tools that are state of the art that we're always updating. We have trade rooms you can get access to. As a reminder for everyone, the all-in training where I go in and I talk about trading psychology and how to deal with the challenges of trading psychology, which, you can have the best system in the world and mess it up, right? So, things that you just need to know. Also, like the ability to read the market. And so if you haven't checked that out, hop on our homepage at apexinvesting.com. Check it out. We did a live event with this, and we had people attending via stream, live, and of course, now via recording, and we even have a room for questions. So if you're wanting to, sort of figure out how to solve some of those issues, to overcome yourself, and also how to dig deep into yourself, figure out how to deal with those challenges, how to dig deep into the market. That's what the all-in training is about. If you're looking for a system, we have the KISS trading membership where you can hop in as the bronze elite membership, and it gives you simple objective entries for exits in any market. We show you dynamic ways to adjust to market conditions. You get a market report. I show you how to reduce your risk into the advanced tradings, how to capture more profits using things like order prints and VAD. And we go into a whole lot more than I can cover right now. But just wanted to give you a heads up on that. Also, if you haven't checked it out, a lot of y'all I know have attended the integrations where I teach you how to do ultimate hedges. That's of course something you can apply to the micros as well. And I go into futures and forex and spreads and touch brackets. I touch on psychology and dive really deep again into ultimate hedges and money management and a lot of the benefits that go with that in the integrations course. And we have the binary breakout mastery course. So if you're wanting to learn how to master trading binaries on Nadex, then that is definitely the course for you. So again, all these courses are on our website. So with that out of the way, let's go ahead and again, we're going to dive into micro futures contracts. Now, a lot of y'all know about the index contracts, but there's actually over 10 markets that have micros available. So I'm going to teach you not only about the 4 new ones, but the other ones that you may not even be aware of that you can access. And one of the things that we're going to talk about today that I think is one of the most important things that some people I think maybe don't easily understand because they're similar, is that they're similar but they're not the same. Okay, and so we're going to dive into the similarities, but we're also going to dive into the differences that if you don't know about them can have a severe impact on your trading. We're going to go into fees. It's something you obviously need to be aware of when you're trading. We're going to go into the full or the minis, just depending upon the contract, the micros, the spreads, the touch brackets, putting all of them together on the fees. We're going to dive into margins, how much you're looking at putting up for a contract, how much you're looking at to stay in the contract. And we're also going to go into bid offer spreads on micros. And a big piece is how it impacts your trading. Something that if you don't understand true bid offer spread, not just bid offer spread, but true bid offer spread, then you could sort of easily make a false assumption that I've actually already seen traders make that hopefully I can help you with tonight. And we're also going to talk about volume and how it impacts reading the micros versus the mini or full contracts, so you're not using the wrong information to read the chart and why it actually matters. So does that sound like a pretty good place to start out and dive into the topic here? So awesome. All right, so let's talk about first just real quick on how to access the micro futures. Now, of course, at Apex Investing, we use NinjaTrader. So you'll need to make sure that if you haven't done it already, that you update to the latest version of NinjaTrader 7. Just hop on their website, type in your email. You can say, I don't need data. It'll take you right to the download page. Download the latest version. Open it up and go to Tools, Options, Reset Instruments. Okay, this is really important because basically you're having to tell Ninja to go in and pull the new instruments that you're wanting to be able to look at. Okay, and then update your Apex toolkit to the latest version because we've included micros in that version now for you as well. So you'll be able to take advantage of those. Now, once you've done that, open Ninja up, close Ninja, and reopen it. I know that sounds sort of funny, like why would you need to open it and close it? Well, because you're trying to make all the changes take effect, okay? And then you're going to add the micros to your instrument list. And I'm actually going to go over what all the symbols are so you know what they are for each micro that's out there. And, you can add it to your instrument list. If you don't know where the reset instruments are, you just go over here to Tools, Options, go to Data, and then you'll see a thing that says Reset Instruments. And you just click that right there. Okay? And a reminder, again, after you do that, you're going to close it and reopen it. Then add them to your instrument list, and then go back in and change your instruments to use default 24/7. So how do you do that? You just go to Tools, Instrument Manager. And, I've already got them all in here, but let's say, let's say I'm looking up MNQ for the micro Nasdaq. Then I click here, I click Edit, and then on the session template, I can hit D twice and default 24/7 will come up and I click OK. That's all I got to do. Okay. So just go in on any of the instruments that you have. It's really a pain to do, but you do it once and you're done until brand new contracts come out. And I don't mean new months. I mean like a whole new instrument, like a mini or a micro Nasdaq or something. So just make sure, you can take a screenshot of that picture or whatever. But again, update Ninja to the latest version, open and reset your instruments and close Ninja, update your toolkit to the latest version, open and close Ninja, then reopen it, add your instrument list, all the new micros to it, and then go back and change your instruments to use hours of default 24/7. After that point, you will be set. This is not something you need to repeat. Okay. So let's talk about what micro futures you should actually consider. So there's the S&P, there's Nasdaq, there's the Dow, there's the Russell, and you also have the FDax. And I'm going to go into each one of them here in a little bit. I'm just going to sort of go over an overview for you first. Then we're going to go into there's gold, oil, and natural gas that you can trade that have a smaller version than the main contract. And gold actually has two smaller versions. There's 6E, 6B, and 6A. So the Euro FX, the Pound FX, and then the Aust FX. Okay? So you got 11 markets that you should consider. Now there are other micros. Okay? So let's talk about which ones you probably want to avoid. There is a Nifty, the Hang Seng, heating oil, unleaded gasoline, copper, silver, corn, soybeans, wheat, CAD dollar, pound dollar, and franc dollar. So these have micro counterparts, but they're really illiquid. They can gap really fast. They don't have a lot of volume. They can just jump over things. Some of them don't even have enough data to open a basic chart. So these are micros right here, and you don't need to memorize them. Just if you start looking up all the micros that exist, these are ones you probably just want to avoid. Okay. And, a reminder, you can trade copper, silver, corn, soybeans on Nadex spreads. Okay. And you could trade those for $1 a tick. And then you could trade dollar CAD, dollar yen, dollar franc, pound yen, euro pound, euro yen. All those can be traded on spot FX as well, of course. You get better margin with spreads and you get no stops. And the dollar yen also has the Nadex touch brackets. So just to, this is more just to let you know if you want to trade a smaller size in the future contract, you can do that through Nadex or spot FX. Okay. And again, avoid these contracts right here. So the next thing I want to go into with is, account size. One of the coolest things about the micro FX contracts is they take so little to trade. Instead of needing, $3, $5, $10, $20, $50,000, you can go in and open an account with as little as $400 and actually trade it. Would that help some of you? So yeah. So and I mean, I saw one trader go, man, I could trade these things all day long. So it allows you to really trade, and again, it helps a lot with that psychology because a lot of you are over trading your accounts. So it'll help you get that. Maybe you're wanting to take that jump from demo to live, but you don't want to go in full throttle at 5 or 10 or 12.50 a tick. Well, now you can do that with the micros. Okay. And yeah, you can even do, Ronald mentions, he's done 5 contracts on mini Nasdaq and it's only, 250 a tick. Exactly. So you don't even have to just do just one. You can do multiple. Um, so again, my first point that I want to go over with you is that they're similar, but they're not the same. And we're going to look through examples of all the micros that I was talking about, those 11 micros. Okay. And the pricing and the bid-ask differences can be different by, 1 to 4 ticks at times. And you're going to see what I mean by that in a second when I go through true bid offer versus simply bid offer. And 1 tick can make a huge difference on wicks and reversals. Y'all agree? I mean, it's like 1 more tick can cause a wick versus be a reversal bar. Does that make sense? So if you're aware of that, would you expect the charts to always match? Like bar for bar? Exactly. No, they're not going to match bar for bar. So let's look at a side-by-side comparison. Here's the mini Nasdaq over here, and here's the Nasdaq. And I highlighted a lot of the differences. So you can see over here on the mini Nasdaq, we didn't get a kiss long until the 3rd bar. On the Nasdaq, we got it on the 2nd bar. Okay. We can also see that, obviously since we got it on the 2nd bar, went 1, 2, 3, 4 bars. This would only win, 1, 2, 3, 4 bars. Now it looks pretty similar, but then we go down and look, we get another extra bar short on the mini Nasdaq, and we didn't get one on the Nasdaq. What was the difference? Why did we get an extra bar short? Because literally a couple ticks, and really that has to do with true bid offer. Okay, so literally just a couple ticks make a whole new bar, and now instead of getting 2 green bars up, we get 3 up, and we get a kiss arrow. We didn't even have a kiss arrow over here. Okay, so do y'all see just those similar? I mean, this chart, like just the untrained eye, could look the same, but do you see how it can easily, literally? I mean, you're talking about a different bar, different signal, things like that. Does that make sense to everyone? Like how it's similar but not the same? Any questions on that? And we'll dive into some more examples and why that's important. But first, I really want you to see that, because if you're trying to trade mini Nasdaq off the mini Nasdaq chart, and you're looking at the Nasdaq chart, you're going to be upset because things don't match. So what I usually do is, if I'm going to trade this, or if somebody's going to trade this, then to me the best course of action is actually to place my trades based on the Nasdaq chart, but I put them on the mini Nasdaq chart. I know it's not going to match exactly. Now I may use just a 10-minute chart, or I may just, for at least it's similar, so I'll go ahead and put it on the mini Nasdaq chart. But I'm going to place my order, X ticks below, only when there's an arrow here, not when there's an arrow over here. I want it to be on the Nasdaq chart. You can even take your indicators off this side if you wanted to. But I make my decisions based on the larger contract, because this one is going to be more wicky just because of the bid offer. Okay, so let's go into the first example on the S&P 500. So on the S&P 500, we got ES. It's $12.50 a tick. It ticks in quarters, or 0.25, so it's $50 a point because there's 4 quarters in a dollar. It's $1.89 to $2.49 per side. By the way, all the fees I'm quoting are the current, but I don't know if they're the future, right? Fees of NinjaTrader when I'm talking about the futures on here. Okay, so $1.89 to $2.49 per side, depending upon whether you own or have the free version of Ninja. And then you got the micro E-minis, $1.25. The micros trade at 1/10. The micro indexes trade at 1/10 the size of the mini contract. So ES is literally called the E-mini. There's a full size S&P 500, which is what's traded on the floor, but there's also the ES, which is the E-minis, which is what we trade electronically. And then there's the E-micro, which now is available for you to trade electronically. It's it's micro, it's smaller than the mini contract. Okay? And at $1.25 a tick, it also ticks in quarters at $5 a point. Fees are 41 cents, really cheap, to 61 cents per side. Now, if I took those fees and I said, okay, this is a tenth, it would take 10 of these to equal one of these, right? $1.25 a tick, $12.50 a tick. So I have to multiply out all my fees, and 41 cents times 10 is $4.10. 61 cents times 10 is $6.10. So I'm actually paying a lot more in fees compared to the mini when I trade a micro. But I don't have to do the full size, all that stuff. I'm only paying 41 cents a contract. It's just, I wouldn't want to do 10 micros versus one mini, right? Like, why pay all that extra money? So if I'm going to do 10, just trade the mini, which is ES. And now if we equalize the Nadex spreads, it basically, since these are, trading, they're basically about double. So it takes about 2 to 1, a little more than 2 to 1. So it's somewhere around the same price on the S&P, 82 cents to $1.22. Okay. And then over here on Nadex spreads, it's $1 a tick at 10 cents a tick, or $10 a point. So it ticks a little bit differently. It ticks in dimes versus in quarters. These are $1 per side. You have to do 5 of them for $50 a point, $10 a point, $50 a point. So you have to do 5 of them. So it'd be basically $5 in fees to get in the trade. Now there's no fees on settlement if you have a max loss on spreads. So that's sort of a bonus. And then it's the exact same thing on touch brackets. Okay, $1 per side, and then no fee if sells a max loss on a touch bracket if it's the wrong side of your bracket there. So that's the S&P 500. Now let's look at DOMs. So what do you make of what is a DOM? DOM means depth of market, and you can open that up over here. If you go to File, New, and you click on either Static Super DOM if you have the free or fully licensed version. If you don't, you can also check out the Dynamic Super DOM. I prefer the static one. It doesn't jump around as much. That comes with the higher version of Ninja. So anyways, but that's how you open it up, and then you just select your instrument, and it pulls up for you. Okay? So you can see I have the Mini ES, and I have the Micro ES. Okay? And I'm side by side. You can see they're priced the same in this case, right? Here's the Mini. Here's the Micro. And we go over here and we can see that, these are the Nadex spreads right here. They're priced pretty much at the same. The indicative's at 1218.934. Okay. So we can see all that. And, if I look at margin on the S&P 500 E-minis, I'm going to trade $500 a contract for intraday margin. All right. Now, if I hold it, I pretty much past 412, 13, technically 415, but some brokers require it a few minutes earlier. Then I have to put up $6,930 to open it through the close. That's quite a bit, right? So if I go to the micros, it's only $50 to open a contract up and for intraday trading. But if I hold through the close, it's a tenth at $693 through the close. To hold on to that. Now the spreads in the touch brackets, here's a couple examples for you. So this is a touch bracket. And it shows $275 or $225. Margin is my risk. $33 margin is my risk. It doesn't change. Okay. So these are both touch bracket examples. I can also throw spread examples up, and I'll show that on some of the other markets. But it doesn't go up if I hold it through the close on a touch bracket. They trade on weekly time frames, and or they expiration is every week. You can trade them in 5-minute or 1-minute increments if you want to. But I could actually literally put up $33 and have no stop. So I'm not ever going to have a margin call on Nadex, and there's no overnight margin. And, the margin doesn't fluctuate with my P&L. I don't have to worry about fast markets making it fluctuate, things like that. With CME, I get, a little head game advantage, right? I have smaller value, only 50 cents on the micros. I have, quite a bit more liquidity. I got to cut it all in half because remember, these are worth 50 cents and these are worth $1. But I have a lot of liquidity over here, and there's more liquidity in the spreads. But I have quite a bit of liquidity. And remember, these are only 50 cents, so it takes 10 of these to equal one of these. So 20 means 2. Okay, as far as the minis, 162 means 16. 308 means 246. So they're not even. They look super liquid, but they're not as liquid as they look. Because remember, they're a tenth of the size as the minis. that make sense to everyone so far? Awesome. Okay. So just trying to make sure I'm not losing you. So they're similar to corresponding markets. Again, the micros may be very similar. Sometimes they look the same. And sort of like Nadex is similar, but they're a little more similar than an option, especially when you have the indicative. On Nadex, you have an indicative price, which has its advantages too. We'll talk about that. But it uses the average of it takes the last 25 prices, it drops the highest 5 and lowest 5, averages the middle 15, and that's what the price is based on. And that's what the settlement's based on. So that can sort of slow it down a little bit, which can be good at times, because maybe you don't get in if you're getting in based on the indicative, out if you're getting out based on the indicative. You may be able to avoid little wicks here and there, things like that. But also it can make it a little more challenging for scalping. So let's talk, we'll talk more about the scalping aspect here in a minute, but let's check out Nasdaq. So on Nasdaq, we got $5 a tick. Ticket in quarters at $20 a point. $1.89 to $2.49 a side. That's CME, NFA, broker, all that stuff. Then we got the micro Nasdaq. 50 cents a tick, $2 a point versus 20. Fees are 41 cents to 61 cents a side. Obviously, you multiply that times 10 to equalize them to the corresponding mini, to the micro there. And if you equalize them, the Nadex spreads, you have to add a little bit more in. And let's see here. The spreads, you'd actually do like $2 to $3. Because here's the thing is the spreads tick differently on Nadex. They tick in 0.1. So it's actually cheaper to trade the Nadex spreads on Nasdaq, but you also have to deal with premium and things like that. Now on the touch brackets, it's pretty similar, same in the pricing, and the movement's very similar as well. So Nadex spread, just like everything else, dollar a tick. In this case, ticks and dimes, not quarters. At $10 a point, buck a side, $2 round turn. If you equalize it, since it's $10 a point, $20 a point, you'll got to do 2 of them. So it'll be $2 per side, pretty close to what it takes to trade futures on the spreads. Now it's a little bit different on the touch brackets because they trade the same. They trade $1 tick, but at a quarter, just like their counterpart. So it takes 5 of them. $4 a point, $20 a point. Therefore, 20 divided by into 4 is 5. Okay. And the fees are $1 per side. So the fees equalized, basically $5 a side, and there's no fees on settlement if you hit max loss. All right, so that's Nasdaq. Let's look at Nasdaq itself. Okay, so again, what I did on this one here is I actually have up a touch bracket, a couple touch bracket contracts, and I have the mini and the micros on it, just to let you look at these. And you can see the price is similar, but it's not the same. Notice right there, okay? And here's something I want you to start looking at. And this is where I get into, true bid offer versus bid offer. 3 contracts, that's $1.50 a tick. 2 contracts, that's a dollar. I mean, most people can take out those, right? 12, 11. Okay, so remember, 12 of those is just like 10 of these is 1 contract over here. Okay, so would it be pretty easy for somebody to take out 3 and 12? I mean, would it take that many traders? They don't even have to have big accounts to take out all these contracts either way. 12, the 3, the 2, the 11, like all 4 of those levels. No, I mean, it wouldn't take much at all to take that out. Okay, so when you start seeing the larger sizes, like let's say we get up here to 30 and 60, that's what I would call your true bid offer. Okay, because it actually has to at least eat through some contracts in order to not wick and just hit that. I mean, it can wick and hit those other contracts in a heartbeat without a lot of volume having to come through. Okay, so do you understand where I'm getting like here we sort of have a 4 tick wide bid offer, 4 to even 6 if you went 33 down to 64 bid offer spread. Does that make sense? I mean, yeah, you could get in and only have 1 tick, but it also could just wick, like literally, from here to here, mean, just to hit those points is 6 ticks, and all it's got to do is take out, what, 15, 26, 27 contracts, which is only equal to almost 3 contracts over on Nasdaq. So do you think this might impact how your charts plot? It might impact where you want to put your stops? Do you think you want to put a stop right here where there's only 2 contracts sitting? No, you want to think about a deeper level. Now, I'm not saying you have to watch the DOM all the time, okay? But I would say it is wise to open the DOM up, because you think this might change at night versus during the day? You think these might not be maybe as narrow during the evening when there's a lot less volume happening? I mean, I've literally seen this be 3, 4 ticks, like with nothing in between in the evening. So I got to look and find out where I actually start seeing a little bit of buildup to know just how wide I need to account for just simple wicks to take place. Okay, so let's say we're looking at this, and we're like, okay, from here to here is like 6 ticks, from the 33 down to the 64. And I normally put my stop, and I'm trading the micros, okay, and I normally put my stop 1 tick below the high, of the setup bar, right? Well, that's accounting for like a 1 tick wide bid offer, which works great in certain liquid markets. In other markets that aren't as liquid, I might need to use a little wider. So how wide would I maybe want to use? And this actually could apply to Nasdaq as well. But would I want to use 1 tick below, or would I maybe want to use like that full bid offer, like 6 ticks below? Yeah, 6 ticks exactly. So Shane says maybe even 7 ticks exactly. And so I want to look at that DOM and just have an idea on, okay, if the rule is 1 tick below, maybe I want to use 6 to 7 ticks below for my stop. Now I want to get in as quick as I can on that tight bid offer, but for my stop loss, I need to understand it may just pounce. Okay. Now the good news is it's 50 cents a tick, so we're only talking like $3.50 or $3 at like 6 ticks. Okay. Now here's something that might open a couple of your eyes as well. You're trading Nasdaq. Look at how many contracts before you get to double digits there. Now remember, 11 would equal like 110, 4 would equal 40, 6 would equal 60, right? So it's actually more like about 4 ticks between 4 and 6 on the Nasdaq futures. Do y'all see that? This is on the E-minis. Any of y'all ever get frustrated with this? It comes down and it pops it by a tick or 2 ticks, and then it goes right back up. Anybody have that issue? Especially on Nasdaq out of all the markets? Do you think this might be why? Only 2 contracts have to be bought. There's no wall in the way at all. So when you're trading a contract, now understand there's an insane amount of volume that goes through Nasdaq, but there's not an insane amount of limits. If we go back and we look at ES, I mean, look at this. We got 124, 153, 240. I mean, we got some volume, right? If we go over and we trade Nasdaq, we're trading a less liquid instrument that's going to be by nature more wicky, okay? And that's the best word I can come up with for it. But we might want to account in our stops for the expectation of wicks where there's no contracts it has to get through. Is that an aha moment for anybody? That looking at this DOM could actually tell you why you're getting wicked out on a constant basis. Yeah. Now, if you're going in and you're, scalping for, let's talk about a little bit different topic. If you're scalping, for like 10 or 20 ticks, this is great. You hop in. I mean, it's narrow, goes up. You got a nice narrow bid offer. Over here, you have like, a 3 tick constant bid offer. I mean, you got 20 of them. I remember over here, this is only half, right? So that's like 1.5, right? That's like 6 Nadex touch brackets. That's like 15. Okay. So it may look like this has a tighter bid offer, but when you really look at where you start even getting close, their size. 20 of these is 40 over here. So let's just say there's 30 and 60. So if we actually look volume to volume on this right here, then really this is about a 6-tick wide true bid offer. Okay? So this might actually be narrower on Nadex. I'm not even saying that you need to trade Nadex or you need to trade micros, you need to trade minis. I'm just trying to make you aware. So when you're trading, you can make decisions according to the market you're trading. You understand the instrument. So this may not be as wide as it really looks like it is. Right? So this looks like it's much wider here because it's 1-tick bid offer. Yeah, but it only takes a $1.53 contract to go in and, take all those out. Over here, to take all 20 of these out, you're gonna have to put up like $2,300. And there's about 21 sitting right there a tick away. So and I even put a couple different contracts in to show you. Okay. So now Nasdaq, $500 margin. If you want to hold Nasdaq through the close, you're gonna put up $7,600. The micro Nasdaq, $50 intraday, which is amazingly awesome. You want to hold through the close, $760. Again, spreads and touch brackets on Nadex, you're not having to hold it through the close. So now, one of the things I love about these micros, and that I know a lot of you like about them as well, and even about minis, one of my favorite things is I like trading off charts. How about y'all? Do y'all like trading exactly off the chart you're using? Makes things a little bit easier, right? So yes, it's much easier. So like I'm telling you all these like things about Nadex versus micros, but there are goods on both sides. Okay. And I've been absolutely impressed with the micros. I mean, they launched with 15 market makers, millions of transactions their first week. So I mean, they're sort of where they're going to be. I mean, the volume could go up, but that's probably about what it's going to be. Okay. So I wouldn't be waiting around for it to get a whole lot higher. I think they've sort of hit where they're going to be. I mean, having that many market makers out of the gate. Now, you don't have the delay on the indicative with the micros, which is a cool benefit. Um, but I've also had trades where I have an indicative stop and I see it come down on my chart and hit the stop, but it doesn't actually hit the stop on the indicative because of the average, and then it goes back up. So I've actually seen that indicative as a big edge for my stops themselves. Now I've also seen the edge over here. We can go in and you can scout for 10 or 20 ticks, whereas that may be harder over here because of that slower movement with the indicative itself. So for scalping, definitely the micros, have an edge, depending upon how small your scalp is. If you're doing 10 or 20 tick scalps. But the big thing is, don't simply look at it and go, oh, well, that's a 3-tick wide, and that's a 1-tick wide. Well, not really. Not when you look at trying to compare at least some of the volume together. Remember, 33 is just 15 over here, right? Okay, so what about the Dow? Let's check it out. Dow, $5 a tick. Ticks in one single unit, $5 a point. Fees are $1.89 or $2.49 per side. The micros tick at 50 cents a tick. And notice all of the like the Nasdaq, the Dow, and the Russell, which we'll go over in a minute, all tick in 50 cents. ES ticks at $1.25. Okay, so it's $1.25 a tick on ES. So if you equalize the fees, again, you got to do 10 of them. So $4.10 to $6.10 per side, a lot more expensive if you're doing a lot of them. But again, you can lower your tick value. You can do half, you can do 5, you can do 1. 90x spreads, it's pretty much the same, 82 to $1.22 a side. So buck a side, so right there in the average. And of course, these would be $5 a side, and no fees on settlement with max loss on spreads. Same on touch brackets. Okay, on the Dow. So pretty simple. Let's dive into, and I want to, the reason I'm going through all these DOM examples is I want you to see it. I like really, really see it. Because some people go in and they're like, oh, well, the spreads are so much wider, but they don't ever really look at what the bid offer spreads are. This is the Dow. This is middle of the day, middle of the trading day. This is not like low liquidity time right here, okay? Look at that. Our Dow is 2 ticks wide. 2 ticks wide here. And what is it over here? 2 ticks wide. You'll see it across the board, 2 ticks wide. Now, it takes 10 of these to equal 1 of these, right? So 11 is really like 110 over here. So we got, decent number here on the Dow. Got a very small number on the micro. And then for our true bid offer, saying getting somewhere close to 25 or 30, if we went below that, 23 to 18, I mean, we got 1, 2, 3, 4, 5, 6, 7 ticks wide. That's before we hit like this 100 number up here. So do you think wicks could happen pretty quick if, it only takes 25, 30 contracts out of millions being traded to pop through that, causing, wicks on your chart? Whereas these are going to be driven by the indicative. They're not going to make those wicks so easy in the sense of like just get stopped out so easily on a wick because that indicative slows it down. Again, very good for certain trades, a little more challenging for scalping trades. On the Dow, you got $500 intraday margin, $5,900 through the close, $50 intraday on the micros, $590 through the close. Spreads, whatever you put up, $72, $170, that's all you got to put up for period. And whatever the risk is, that is your margin, and it does not change during fast markets. It does not change during rollover. It does not change with P&L going up and down. Like, that's your max risk, and it's the max amount of cash you have to put up. All right, so now let's check out the Russell. All right, now, by the way, all these symbols so far, I don't know if you noticed a little pattern. Like, it's been MES, MNQ, NYM. It changes when we get to Russell. Okay, Russell's $5 a tick, ticks in 0.1, $50 a point, same fees, $1.89, $2.49 a side. The symbol is M2K or Russell 2000 or small cap 2000. Okay, 2000 small cap stocks inside that index. Trades at 50 cents a tick, 0.1, $5 a point, 41 to 61 cents a side, so 410 to 610. Basically, exact same information there on the micros. Nadex spreads, $1 a tick. Ticket in 0.1, $10 a point. Takes 5 of them to equal a RTY contract. Same thing with the touch brackets. Okay? So let's check out the liquidity on these. So we go in and, 11, 11, 9, 9, 14. Then we get to 149 and 66. So about 7 ticks or so. Or some true volume that has to, be pounced through before we get there. We got 6 ticks over here, but that actually is pretty close to what we see over here. Now on the full size, we still have a 2 tick wide bid offer. So we're only talking, 4 or 5 more ticks here, 4 more ticks on this than we are on the full size contract, but only $1 a tick. This one we're talking about, 6 or 7 ticks that it could just fly through. So does that make sense to everyone? Any questions on that piece so far? Sort of the indexes. And then let me see here. Somebody said something about. Yeah, that was right. The slide does say 50. Oh, has a decimal in the wrong spot. There you go. 50 cents a tick. So yeah, 50 cents a tick on on the small cap Dow and Nasdaq, $1.25 on that. Now, what about the German 30? This is something that a lot of y'all haven't looked at. Okay, it's known as the FDax. One of my favorite markets to trade. Now you have to have, an actual account, but you might actually be able to fund one now. Now that you can do it with less money, depending on where you're at. But you fund an account and get this data. You can trade it on Nadex. You can also trade it. They have a smaller contract. So it's 12.50 euros a tick, which is about $12.50 in dollars. It's a little bit different, but they trade pretty close to par, at least at this volume. So about $12.50 a tick at ticking in halves. So ticking in 50 cents, so 2 ticks right per dollar for 25 euros a point. It's $1.65 to $2.24 a side. The FDXM is the micro or the mini of the FDax. Okay, so I'm just talking about the smaller counterpart there. 5 euros a tick in one at 5 euros a point. So they tick in whole points versus half points, and they're €5 each. Okay? So basically, €5 a point versus €25 a point. It takes 5 of these to equal one of these. So you take the fee of $1.09 and multiply it times 5, or up to $1.89 and multiply it times 5. It can make a big difference right there on your fee. And then you got Nadex spreads. They tick in $1 a tick. Now they're $1, not euros, which is nice. And they tick in one at $1 a point. The fees are $1 a side, and they're equalized to FDax. $25 a side basically would be $25. Okay. And you can also chart FDXM. Now again, like I've said, you need to be making your decisions on, if you're going to trade FDXM, you need to make your decisions on the FDax chart. If you're going to be trading mini Nasdaq or micro Nasdaqs, you need to be looking at the NQ chart. If you're going to be trading micro ES, you need to be looking at the ES chart, right? So on all these, you want to be making your decisions based on the full size chart. We'll talk more about why, and we'll show some good examples here in a little bit. But yes, you can chart them as long as you have the data. Now, looking at, this is looking at this right here. Now, remember, these are $25 a tick. They don't quote as heavy, but they're worth a lot and they move a lot. This is sort of like the Nasdaq of Europe. Okay, that's how I sort of look at FDax because of the volatility that it has. Now, $25 a tick. I mean, you got a 2-tick wide bid offer. I mean, you're literally talking, or $12.50 a tick. I'm sorry, 2 ticks wide. You're talking about $25 for bid offer spread. Okay. You go over here, you got about the same all the way down. Now remember, 10 of these equals 1 of these, so it's like having 1 all the way up, 1 all the way down. Okay? And so if you set at least to the doubles right there, you got 3 of them wide. So again, now they're taking at whole points. These are taking at half. So 3 wide is $3 wide versus this is just $1 wide. So really it's twice as large as it looks. And then over here you got 4 whole points wide, about the same when you look at 10 to 12. So 1, 2, 3, 4. So pretty much the same as the micros on your bid offers over here on Nadex spread. Okay. And now if FDax takes $2,500 intraday margin. Okay. And takes $853 to hold it through the close. FDXM, the mini, is $1,000 to trade. Intraday is $4,170 total through the close. Spreads, the risk again does not change. Whatever your risk is, that is your margin that you put up. FDax is not on the CME, so it's actually based on the Euros exchange over in Europe. So it's a different data feed than simply the CME bundle. But you can always contact your broker and say, hey, what can I do to get access to FDax? What's the cheapest way for me to get access to it? Or FDXM. Now, crude oil. Crude oil is on the CME. It's $10 a tick at 0.01 or $1,000 a point. Okay? So if oil changes, because it's 1,000 barrels of oil, 221 to 281 per side. Now the QM, which is something that a lot of y'all maybe have not looked at, decently liquid, $12.50 a tick. So it's a higher dollar amount per tick. Okay? How is it a mini? Well, because it ticks right there in quarters, or not even really in quarters, in like 0.025 and 2.5 cents. Okay, so for every 2.5 ticks on oil is 1 tick on QM, on mini oil. So it's worth $500 a point. That's what it comes out to, because you got 4 of those equals 1 of these. So I don't know, 4, 2, whatever you want to look at it as. But basically, this is 500 barrels of oil. This is 1,000 barrels of oil. So that's $500 a point. That's $1,000 a point if you multiply it all out. So if you want to do the fun math, you can. But this one confuses people because they see this larger tick value. They don't understand that it's got also has a larger amount of movement required to move that much. So it has to move 2.5 ticks to be worth $12.50. 2.5 ticks of oil. Does that make sense? I know it's a little bit confusing. We on the same page there? 0.025, 0.01. So I'm assuming everybody has that because I know, like I said, that probably could be one of the most confusing things to see a larger tick size on a smaller instrument. But again, if you look at the larger tick, minimum tick, 2.5 oil ticks equals 1 mini tick. So 2.5 oil ticks would be $25, right? $10 at 0.01, 2.5 times that, $25. So this is half the size of 2.5 right there. So that's $25. That's $12.50. So hopefully that one makes sense to everyone. But if you want to trade something that is worth less per tick on a chart on oil, QM can be your go-to. Now you also, of course, have Nadex spreads at only $1 a tick, ticking in 0.01, just like the underlying. $100 a point versus $1,000 a point versus $500 a point. And then let's see here, fees equalized. Let me change this up. There's so many of these I was trying to go in and do for you. So $10 per side there. Okay. All right. So now let's go in here and look at the oil chart itself, or not the chart, but the DOM. And I want to make sure, are y'all able to still hear me? So I saw like there was some little thing that dropped off for a second, but I think it came back on. Okay, cool. Everybody's just listening. All right. Okay, so on oil right here, we got, 58. Look at this is the full oil. This is the mini, micro, whatever you want to call it. It's really more like a mini because it's not all the way at a tenth of the size. It's half the size. But you go to look at, 42 by 26, very liquid. 23 by 26, actually pretty liquid, right? I mean, it's only half the size, so that's not bad. So it's actually pretty liquid. Oil, you could actually trade with those one tick rules. It's really liquid. You go over here, I mean, it's only 2 ticks wide on the spread. That's not bad at all. So, 1 tick versus 2 tick, and you got capped risk. So, if we look at oil, you're putting up $1,000 intraday, $31.50 through the close. QM, we're putting up $500 intraday, $15.75 through the close. Spreads, you can't hold through the close, but your margin doesn't go up as you have a loss. Sort of like, if you go over here and you put up $500, but you have a $100 drawdown, that's $600 coming out of your account. You have a $200 drawdown, that's $700 coming out of your account. So, whereas this, if you put up 223 is all that comes out of your account because your max. Again, you don't have to take the max loss, but the worst possible loss is what's put up on a spread. Natural gas, something else y'all may not have looked at. $10 a tick, ticks in 0.001, 221 to 281 side. QG, which is actually still decently liquid. Not super liquid, but liquid enough. These are $1.21 to $1.81 a side, equalized 605 to 905 a side. Or you can go down to Nadex spreads. Okay. Notice here too, it ticks in 0.005. See that? This is another weird one, sort of like the mini oil. It takes 5, like this literally has to move 5 ticks before that moves 1 tick. Does that make sense? So this is 0.001 versus 0.005. Natural gas moves 5 ticks before QG moves 1. That's why the tick dollar amount looks higher, but it's actually not. Because it takes 5, so $50, $12.50. Pretty simple. Meaning like 5 of these ticks would be 50, 1 of these is $12.50, so it's like a fifth the size. So basically multiply that times 5, you get 605 to 905. Nadex spread, bucket tick, 0.001, ticks the same, dollar per side, equalize it out, 10 of them to equal 1, because $1 tick versus $10 a tick, you got $10 per side. Let's see, this one is not $6.25 a tick. This one is $12.50 a tick. It literally ticks 0.005. So this will have to move 5 ticks up or down before this moves 1. So once this moves up 5 ticks, this will move 1 tick. So it is actually $12.50 a tick. But again, its tick is not in 0.001. Its tick is in 0.005. So it ticks at a higher ratio. Natural gas moves up 5 ticks. QG will move up 1 tick. So it's literally a fifth of the size at 12.50 a tick. So yeah, it's pretty weird. But anyways, looking at it over here, you can see, first couple not real liquid. Then you get into at least, doubles. Over here you got about 2 ticks wide. Over here you got about 2 to 4 ticks wide on natural gas versus the micros here. Over here we got 3 ticks wide. So really not bad in comparison, comparing Nadex to the the micros and the natural gas contract right here. Again, margin $1,000 on natural gas, 1,400 through the close. This is a weird one too. QG, $500 intraday. If you hold it through the close though, it's 350, then goes back to 500. It's actually the only contract I know of where holding it through the close has a lower margin than trading it intraday. So don't ask me why, because I don't make the rules, but that's what they are. You can go and check out NinjaTrader's margin fees yourself. And that 350 comes from the CME. But it's the only one that goes down. All the other ones go way up usually. So Nadex has spreads, Nadex has touch brackets, and Nadex has binaries. So they have 3 different types of contracts. And so you could say their touch brackets are sort of like micros in the sense, because they're $1 a tick. The micros, I mean, a lot of these are 50 cents a tick. It depends on, what they are. But, so, I mean, they do have small values per tick, which is, I mean, you can trade 10 or 20 or whatever, That's something also to look at. The 20, remember, that would be 10 over here, right? So this is 3 ticks wide with 20 and 20. And actually, sorry, that'd be 40. I guess I have that backwards. 20 over here would be 40 over here. It'd take twice the amount of contracts. So to equalize the size. But that's sort of what you see. Like I said, just a weird, quirky thing. Fun trivia for traders. What is the one contract that the margin goes down? That would be mini natural gas. Gold. Now, gold has several options. Okay, you got your main gold future, which is $10 a tick at 0.1, $100 a point, 221 to 281 a side. And these fees look a lot more expensive than indexes, but remember, they're also $10 versus like $5, right? A tick. You got QO, which is $12.50 a tick at 0.25. So this is basically half the value, right? Because it takes 10 of these, 10 dimes to equal $100, or to equal 10 dimes to equal $1. So 10 into 100. Well, it takes 4 quarters to equal $1. So 12.50 to equal $50 a point. So this is another weird one. On these commodities is where you see this, where the tick value is higher, but the tick size is larger. So 4 quarters times 12.50 equals $50. Right? 10 dimes times $10 equals $100. So at a 1 point move, this is actually going to be a $100 value. And a 1 point move, this is going to be a $50 value, because it's sort of like in Q, where it's 12.50 tick, right? So not Q, ES, where it's 12.50 a tick, and then you got ticking in quarters. So right there, so fees equalized. You go in and basically double, so 292 and 562. Now you also have a micro. So you got the mini and you got the micro. You got the MGC. Right? $1 tick at 0.1, so $10 a point. Fees are 41 to 61 cents a side, so really cheap. Fees equalized are 410 to 610, so equalizing them to the gold contract. And then the Nadex spread is $1 a tick at 0.1, so $10 a point, the same dollar side. Fees equalized $10 per side. No, fees on settlement. Now let's look at all. Remember, you got 3 choices here. You got a full size there, you got like a half size, and you got a micro size. So looking over here, we got the GC contract. And you can see it's basically 1 tick wide bid offer, 2 ticks for true bid offer, right? Looking at real liquidity right there. Okay. We go over here to the half contract here, the half size. And again, it's only 1 tick bid offer, but like if you're taking at least a double digit number requirement, 12 to 12, about 4 ticks. Okay. We go over here to trade the micro gold. Then you got, 1, 2, 3, basically 4 ticks right there. 3 to 4 ticks. You're going to say 2 if you're not including that, but so a couple ticks wide. Over here, you got 4 ticks on Nadex, but you also have like only got to put up $65 to trade it. So on gold, you're putting up $1,000 intraday. On the half size, you're putting up $500. On the micros, you're putting up $100, and then 3,400, 1,700, and 340. Basically, they just did a divisible of max margin there. Spreads, of course, the same. So question comes up: do I take bid offer into account on my entries? No, I don't. I put my entry at my entry price. So I just account for it for my stop outs. I don't want to get stopped out of a trade that should not have got stopped out. So usually when they're going in my favor, they're going to go. Every once in a while, I may get nicked into one I wouldn't have got in, but very often I'll get kicked out of one that I should not have got kicked out of. I'm more worried about the getting kicked out part when I should not have. So I only account for it on my exit side. And that means if I have an exit up here at this price, I might actually end up not only for a stop loss, but like let's say I bought here and I plan on selling at 1287. Okay, I may actually put it, a few ticks lower here. I got, 1, 2, 3 ticks lower to get out of the trade. So my exits on either side, whether it be a take profit or whether it be a stop loss. Now you also have currency. You got 6E, which ticks at 1250 a tick. It's because it's 12,500 units of currency. Ticks in, or pip. So understand, tick and pip both mean smallest increment value. Okay, now they actually can go to fractional on spot FX pips, but pips and tick have the same definition in the sense of they both mean small increment move. Like tick tock on a clock is seconds, right? So I use the word interchangeably. Fees 231 to 291 a side. M60, the micro, is a tenth of the size, $1.25 a tick. So you can actually trade, if you have a futures account, you can actually trade these micros if you wanted to. If you want to trade FX on them. Fees, now again, this is only euro dollar, pound dollar, and Aussie dollar. The other ones are pretty worthless. The other FX on CME micros. Fees 37 cents to 57 cents a side. Got another extra decimal in there. Let's see here. And then Euro USD mini watts. So this is like spot FX. Either they're $1 a ticket pip at 0.001, which means at 10,000 units of currency. But either don't have a fee and they have a wider bid offer, or they have a fee and they have a narrow bid offer. Usually it comes around to about $1 wide. Nadex spreads, $1 a tick, 0.001, $1 per side. Okay. No fees on settlement. Touch bracket, same thing, $1 a tick. Now, if we go over here and look at the DOMs over here, I mean, this has micros. I mean, this has spot FX, which is almost like zero. But again, the tighter this is, the more they're going to charge you. Like you're not going to get this tight a bid offer with the multiple bank feed and no commission. They're either making their commission in the bid offer or they're charging you a commission, depending upon the plan you choose and the broker you have. Over here, you can see you got a couple ticks wide on the euro. You got a couple ticks, basically, pretty much 1 tick wide. 2 ticks if you go up to 20 wide on the micro. And then we see that we got 2 ticks to 3 ticks wide on the touch bracket. There's 2 ticks. Spread has 1 more tick in there, but there's no stop loss. And you're putting up $33 to place the trade. So out of all the things, I would say FX is my favorite thing to trade on spreads on Nadex because, I mean, there's almost no, right now, at least at this moment, there's almost no premium in them. And you don't have to even use a stop loss. So euro dollar, you're going to put up $200 for 10,000 units, $2,000 for 100,000 units. 6E, which is 125,000 units, you're going to put up $500, $1,800 to hold it through the close. M6E, put up $50, $200 to hold it through the close. So 12,500 units. And then spreads and touch brackets, the risk doesn't change. One contract equals 10,000 units. So just a nice comparison for you there. Again, don't be just look at the bid offer. Look at any other fees associated whenever you're doing a FX transaction on spot, which is the non-futures, non-options market. Let's see here. Would you use the price ladder to see potential resistance for a long entry? Yeah, I do use the DOM price ladder if there's like a really big number. I mean, these doesn't. But if I had like a 300 right here, so just pretend like this 16 is a 300. Okay. Would I want my entry to be right before that 300? Like if all these numbers were the same and I had a 300 right there, would I want my entry to be right before the 300 or right after the 300? What do you think? You mean? Yeah. Wow. Yeah. Exactly. I'd want it after. I'd want it on the other side. This is my favorite thing about DOMs, by the way. I mean, one, beyond understanding the true bid offer, but when I see just a massive price amount, now I'm not going to go like move it around a whole bunch if it keeps moving, but if I see a huge number and I have an entry, I want it on the other side. If I have a stop, I want it on the other side, right? I don't want my stop loss to be like right in front of a huge number that it has to plow through. So if there's like a resistance or a support level where you see in the sense of resistance in a lot of contracts on the DOM, I'll use that to actually adjust my entry or adjust my stop. And most traders never even look at this, and they totally give themselves a disadvantage by doing it. Because it's like it has to eat all those limit orders to go through it. So as long as there's market orders there, usually you won't see it move past it. So yeah, I definitely use that to see it. And I tell people that, and I tell people that, and I tell most people just never listen. But I'm like, dude, the DOM is like such a massive, valuable thing. It can help you stay out of trades. Think about those trades where you hop in, it goes one tick to the tick where you were entering, and then turns around. What if you had the DOM up and there was $300, like there was three, 4 times the amount sitting just a tick above where you got in? Maybe you could have actually put your order one tick higher and you wouldn't have got in that trade. So this is not slippage. Okay, I'm not talking about slippage at all. This is in fast markets. This is in slow markets. Let's go backwards. Let's see if we can see any on here. That'll get me off track. It's very easy to do that, but it's a cool lesson. I want to say one of these markets I saw it on. Let's use this as an example. Okay, this isn't perfect, but at least gives you a visual. Okay, see there's 159 contracts. This has nothing to do with slippage at all. 159 contracts. If my buy was to buy at 1502.7, would I want to buy there, or would I rather go ahead and buy 2 ticks higher at 1502.9 so I had to take out all 159 contracts? Where would you rather buy? The area that it has to eat all these contracts where it goes, or buy right before it and make it have to eat all these and bounce and torture the crap out of you? And then maybe it makes it through, or maybe it falls down. I'll give up 2 ticks. I'll take on 2 more ticks of risk on a trade to get on the other side. If I had a stop, if I had buying and stop down here, would I want my stop at 1502.1 where there's 14, or would I want it at 1501.9 where there's 78 where it has to break through 149? So it may reverse against me, it may not. There's no guarantee either way. That number may even move. Okay, but I don't just look for the number. Look for if this 159, like as the market moves up, moves down, moves down. If it's just moving with every tick of the market, that's not what I'm talking about. I'm talking about like you see a huge number and it's just staying there. Market moves up towards it, you still see say 300 or whatever. Market moves down, moves up, it's fluctuating. That number's still there. If that number just keeps adjusting up with every tick, that means the market maker just has a bid offer like set X ticks wide. So relevancy should stick out like a sore thumb. If you don't know if it's relevant, then it's not relevant. Is 159 a lot bigger than all the other numbers on the chart? on the DOM? Okay, then it's relevant. Now, if that 150 just moves up with every tick, like if the market moves up a tick and the 159 moves up again, then that's not relevant. But if that number stays there as the market moves, it's relevant. You know, 3-4 times the size of most of the things on the chart, most of the other DOM price levels. A fixed number, that's a good way to put it, Brent. A fixed number that is about 3 times the size of most of the other quote price levels is relevant. And again, now when I put relevancy on, now again, I said this is a micro, so don't get all caught up in the details on it. Okay, I'm just trying to give you an example. Ignore the thing. All right. So, what do you think I would look at for relevancy? Do you think I'd look at the micro DOM for relevancy of a DOM number, or do you think I'd look at the actual the larger contract? Exactly. I'm not going to look over here at the micro DOM. I'll look at the micro DOM for true bid offer, but for actually a relevant DOM amount, like, do you think the big boys are trading RTY or M2K? Exactly. So I want to make my volume, because that's a volume decision right there. My volume decisions are all about following the crumbs of the big boys. Big boys aren't trading 50 cents a tick. Just, not knocking anybody, just speaking facts, okay? They're not trading that. So I want to make my volume decisions on the larger chart. So on this one, RTY itself, you see nothing. Okay? But on M2K, you see that. But again, I'm not going to base it on M2K. You're probably going to see that number move up and down. It's not going to be static. Okay? And I'm not even telling you to trade RTY. I'm just giving you the examples. So that way you know the facts. Let's see here. I sort of go back and forth on liking RTY. I'll trade it in certain markets and not trade in other markets, but I usually want decent volatility on it. Yeah, we did euro dollar already. Went through that. Pound dollar, it ticks at 625 a tick at 625,000 units. 231, 291 aside, or 0.625. So literally 62 and a half cents a tick. That is right. It's not a typo. 37 to 57 cents aside. Spot pound dollar tick. Okay. Either not, doesn't apply, or it's inside the bid offer, or there's, dollar commission. Then it spreads a bucket tick on each side, come out to 10,000 units of currency. Okay. And then here you got pound dollar, $500 for 10,000 units, $5,000 for 100,000 units. 6B, $500 for intraday, 2,400 through the close. M6B, $50 intraday, 240 through the close. Spreads and touch brackets, the risk doesn't change. So in these two cases, I have a spread and touch bracket up. The touch bracket's $49. The spread is only $39 at 10,000 units, or a buck a tick. So, again, I like if I'm choosing micro FX, I'd have to really have a good reason to not trade spreads. They're just more liquid. You can tell, 4 versus 40, right? Bid offer is the same. We got 2 ticks wide. We got 2 ticks wide. We got 1 tick wide on the full. And I can trade without stops. So, all right. So that's 6B for you. Aussie dollar is really simple. It's $10 a tick, 231 and 291 a side. M6A, the micro there, is a tenth of that. Spot Aussie dollar, the same value, dollar a tick or pip. And then Nadex spreads, a dollar tick pip, so at a dollar side. So pretty easy on Aussie dollar. They're pretty equalized. The touch brackets are the same. And let's see here. Looking at this, we got, plenty of liquidity in the Aussie dollar. We got a little bit, but again, we got that true bid offer sort of kicking in, right? 7.8, 45, 7.9, 41. So you really got about a 6 tick wide bid offer. Over here, you got 3 ticks wide. So this looks narrower because it looks like 1 tick wide, but again, it's only $7 a tick at 7 contracts. So, we got 3 ticks wide with 45 contracts versus 6 ticks wide with 45 contracts over here on the micros. At $300 or $3,000 for 100,000 units, $500 intraday, $13.50 through the close. M6A, $50 intraday, really small. So that's an advantage. You can trade those in your futures account. Intraday, $3.50 through the close. One of the things now, the ATM. So this is a good question that comes up. So one, my entries, whether it be micros or fulls or whatever, are going to be based on the full size chart. So I want to put my entry on what the full size chart says I should get entered on. Okay, but I put my stop based on what the full size chart says it should be, except for I want to count for the true bid offer. So let's say it's 4 ticks wider. Then if my stop is 1 tick below the high, I want to make it like say 4 ticks below the high. What that does mean, and Grant brings up a point about the ATM, is simply go in and add 4 ticks to your stop on the contract. Okay, so if it says place your stop at 16 ticks back, say, okay, I'm going to just, using the stop calculator that we provide to you, then go in and make it 20. So you can still use the ATM. Okay, just add those ticks to the ATM stop. So it doesn't hold you back on that at all. So, because I love using the ATMs. So when it's fast. All right, so I just want to show you some more examples here of charts, similar but not the same. And hopefully, Nathan, I got your question with that right there. Got the mini Nasdaq on the left side. We got the micro Nasdaq on the left side with the mini Nasdaq on the right side. And I want you to notice, we have all these levels up here, which is great. We have them right, we also plotted a, mini magnet right there. But coming on down, notice how we got mini magnet, zone of interest, zone of interest. So all this pointing like short, all this short strength all the way down. Do you think this might give us targets on the way back up that we don't have over here? You think maybe like this might be three mini magnets in a row, that might be a target? Whereas over here, I see nothing at 74.05. They'd have to go 5 more points before I see anything. We got mini magnets on both of these, so that's pretty cool. But we didn't get any of them on here. Now, what are we trying? Who are we following with volume? All these little lines are based on volume. It's called order prints. So something that Apex Investing provides for elite silver and gold members. Do you see that right there? We're following the big boys. Okay, these are just retail traders, not mirror the volume. Remember, it's 1/10 the size. So I could have both up, and they'll be similar, but they won't be the same. Okay? Now, what if I got an arrow on my micro, but not on my mini contract? Would I want to place an order on my micro, or would I want to wait until I got an arrow on my mini? Exactly. I may place the order over here on the micro, but I'm basing it on the mini. So like X ticks below the low. Okay, now I place my order. So a question comes up on the bid offer, going backwards here. Doesn't that fluctuate all day? Yeah, it'll get 1 ticks wide, 2 ticks wide, 3 ticks wide, but you'll see a standard amount. So I'm going to look at it again like in the afternoon, maybe again in the evening, right? But I'm not going to just go in and look at it all day long. I'm going to be like, okay, it's about 4 to 6 ticks wide during this part of the day, like from 9 to 12, maybe a little different from 12 to 4, then it'll be different again from like 6 to midnight or about 2 a.m., right? So just look at the time of day you're trading and what sort of the average size is right there. It'll fluctuate a little bit up and down. That happens all day long. But I'm talking about like, where's my true bid offer looking at? So I can avoid those wicks. I'm not gonna, again, if you get so worried about the certainty of the exact number, you're gonna not be able to make any decision. Some of it you just got to ballpark. It's about 3 to 6 ticks wide or 4 to 6 ticks wide. So, let's check it as sort of go through the day. Let's see here. the charts on my screen. These are from today, or these are from, I don't know which day. They're from this week. um, and it's $100. It's to get in. I think it's $1 trial or something on Kiss, and then it's like $97 a month. We give you order prints for free for the first month, and then it's, if you want to also still have order prints, it's $200 a month, where you can just stay at 97. Okay, so over here now, remember all those magnets we saw stacked up? These mini magnets right here that we teach you about? Had no idea they were over here. Pardon me. No idea. So would I have had any idea to tighten my stop up over here, knowing I'm coming into all these mini magnets? Would I just left it back here? So yeah, I look to the left on the mini, I see all this coming up. I mean, right here, I would have been like, yeah, I may want to tighten my stops up coming into all these. But again, I want multiple things happening. I got stars happening. I got clusters. I got quite a few things stacking up. And knowing it's Nasdaq, my true bid offer is actually several ticks wide. So I wouldn't have it just one tick below the low. I'd have it like 4 ticks below the low. I wouldn't get stopped out on that little itty bitty tick right there. As a star and the cluster, exhaustion and pop prints, all that started happening. Tighten it up, tighten it up, tighten it up, coming into the minute, tighten it up again, out. Now, instead of giving back about 30 ticks, $150, or $15, right? If you're doing a micro, I don't give it back because I paid attention over here. I had both of them up. Wicks are identical. Nope, they are not identical. Let's check it out. Let's see here. Look at these. Look at this chart right here. Because I mean, this sort of shows it, but on this run, look at this, and this is the exact same thing. Nasdaq, mini Nasdaq, same time frame, but just an extra tick makes a new bar. Extra few ticks, right? Made a new bar, popped, went the other way. This one just had a wick, went up. Just had a wick, went up. Look at all that. But if you were basing your stop over here with X ticks, like instead of being right at the volatile trend line, it was like say 4 or 6 ticks below, and it could have came back. You'd been okay, and trailed up with this volatile trend line. To really highlight it, all of these bars is that one bar. All of these bars is that one bar. And it looks massive, but really it's just a few ticks. Literally just a few ticks. But man, it'll confuse the crap out of it. Plus you got these short arrows going on that you didn't obviously have over here. I mean, you wouldn't have taken them because it didn't break below or anything like that, but still, like you'd been out of the trade, whereas you actually could have stayed in the trade all the way up this thing and then tightened up, and I mean, you made a lot more money. At 8 ticks a pop here, that's $40 every additional bar. 40, 80, 120, 160, 200. Like $200 more in your pocket by paying attention. Is it worth paying attention to the mini for $200 and a single trade that only lasted like 2 minutes? I mean, it sounds so ridiculous to ask the question. Well, of course it's worth it. But I mean, how many people after this webinar are not going to look at it? Because it's just too much work to look at 2 charts. $200 in 2 minutes. I mean, that's right there. Like, I'm not even trying to sell you on it. I'm just looking at it. It makes me laugh when people like complain about the cost or they're worried about, man, I got to start making all this money before I can afford to buy that. It's like, how much money are you going to lose trying to make it to afford it? Like, that's one trade. And by the way, that's not how much it made. That's how much additional it made. Right? It got in over here. If we just used the traditional method on this thing, the 70% method, you got 1, 2, 3, 4, 5, 6, 7. So 7 times $280 in 2 minutes, paid for the month, and put money in your pocket. Um, so question. So would trading a higher tick bar size be better on the micros? Nope. Because you're going to have the same issue. It's still the bid offer, the true bid offer coming into effect. And then how are you going to trade a higher tick size with a lower tick size chart on the mini? You got to pay attention to the mini. Let's see, making $240 on that would be one contract, Robert. Just one. Which intraday would be $500 margin on Nasdaq. Or it'd be $24 on a single micro. But yeah, you don't want to use a higher tick rate because it's not going to solve your issue. It's not going to make the wicks go away. It's going to make your chart really confusing. If you do that, just hop over and put on a 10-minute chart, trade off your mini, and put your trades on your 10-minute chart so you're not even looking at it. I mean, that really is probably the easiest solution, but most people want to at least have a similar chart. You have to grasp the fact that it's similar but not the same. See here. Would the MS be a good market to scalp using that system you're trading? I mean, ES. I do avoid most markets on low EV days. I like higher EV days, expected volume days. We put out the report, but I mean, again, I'm only just on ES. I'm just scalping for literally like 2 bars. Go in, I use 8 tick bars, which are really 4 tick bars. So make $100 bill, $100 bill, $100 bill. How many you got to make a day to add up? You can always add in volume, especially on ES. Yeah, Dan says he's actually been using 10 minutes. All right. So again, answering the question, why do you want to base your decisions on micros versus minis? Again, how many hedge fund traders do you think are trading micros at 50 cents a tick? How many market movers are trading micros? Not market makers that just supply bid offer, but movers who actually move the market. The answer would be pretty much none. So if you want to follow the breadcrumbs of the big boys and use that as an edge, we teach a lot of this, by the way, in the Apex Market Mind Mastery course about exactly how to do this. We lay it out and make it simple. Exactly. $1 million accounts are not trading 50-cent instruments. So pay attention to what the people with the big money are doing. Okay? And my recommendation is you don't even have order prints turned on here. I mean, you have the minimum amount of stuff on this chart. You could even put 10-minute charts on. But if that's too confusing for you, then at least narrow down the indicators you don't need a lot on there on your micro chart, and then have what you need on your mini chart, and then just account for the true bid offer on your stops. My biggest tip on going live on Nadex is one, be very careful when going from binary demo to binary live because the prices are massively different. The touch brackets won't matter. They'll be pretty much the same, except for they're not as dependable in demo. Spreads will be similar, but not the same in demo and live. Just my first tip would be watch live and watch demo and record your live prices as you're entering your demo trades to see what your actual numbers would come out as. But be very careful with indexes on Nadex going to live right away, especially if you're underfunded. So like I tell most people, like $3,000 like as a minimum that you probably want in your account to have proper risk reward management. You can start with less, but you're going to make mistakes. So let's see here. And I go into a lot more into Nadex and the integrations. I dive into it. So let's talk about some advantages. Automation. We can automate trading on Nadex, right? So, or not Nadex. We can automate trading on futures and forex. We actually have now built the micros into our automation. We're getting that stuff up and running too. Bid offer is at least a little bit tighter in many instances on micros, but not as tight as it appears when you really compare size to size over on Nadex. A lot of liquidity that we see there. I mean, they're doing really good with 15 market makers. That's been impressive. Refreshing instantly. That's been really impressive. You can trade with charts. Of course, you hop over to Nadex. You can have capped risk. Your margin doesn't change. You can hedge your trades, where I teach you the ultimate hedge strategy in integrations. You can hedge your trades in the same account. You can still hedge them out with two different accounts, but it's easier in the same account. Again, you don't have to worry about fluctuating margins, maintenance margins, all that stuff in Nadex. So again, there's futures and forex we can automate. Often we'll have tighter bid offers, maybe have more liquidity. We can trade on the charts. Again, that's maybe on the liquidity. And then Nadex, we're gonna have that capped risk, single account hedging. Don't have to worry about fluctuating margins. Often put up less money. Let's see here. More into automation. Like I said, we're able to actually automate trade signals for execution. When we can automate, one of the beautiful things about that is you don't have to have NinjaTrader. You don't even have to have a computer. You'll be able to log on, and you can do it through your phone, and you can say follow. You don't have to be logged in. You just log as soon as you sign up. You can say follow. You can turn it on, turn it off, whatever. Um, and that's something we can do on futures and forex. That makes a big difference when we're trying to get in and get out for. Sometimes we got to get out at. Think about KISS. How many times do you get in and get out for 5 tick, 10 tick stop? I mean, as a KISS trader, like a lot of times you're in, you're out 5 ticks, out 5 ticks, out 5 ticks, make 30, right? Do y'all agree? That that's how you trade, right? So, but imagine trying to send that through a manual signal that you're trying to execute. If I'm trying to send a signal to get in and then get out, and then get in and then get out, and then get in and get out, and you're getting a text message, you're trying to log on, you're trying to click the button, you got to sit right there. It's hard to try to send a signal and have it manually followed. If it's automated, I can hop in, hop out. You're in, you're out. There's no, beyond this transmission delay of, say 1 to 3 seconds. Like it's not like 1 minute. I mean, we saw in that one thing where we made, $700 in 2 minutes. Well, what happens if you got the signal a minute in? You missed out on half, right? So that's one of the things we're really looking forward to is so many things we have not been able to do just due to the reality that trying to give time to get in and get out of trades, and it's hard to really do that. So it'll help us a lot with scalping or taking small losses, for putting in a lot of orders and canceling them. I mean, think about how many orders you put in and cancel, put in and cancel, put in and cancel. Like you won't have to worry about. We don't have to worry about you getting 40 messages on cancels a day. Get in, nope, don't get in. Get in if it breaks it, nope, don't get in. Get if it breaks it, nope, don't get in. So when they're fully automated, we won't have to worry about that. And then let's see here. Nadex doesn't currently allow, for automation because they don't have a third party broker, right? You're a direct member of the exchange. So I know some of you are looking for automation, and if you're looking to look at the signal before you place it, look at the chart, put it in, that works great. If you have time to be in front of your computer, all that stuff, then that's great. Or sometimes you have to get the text and hop on and log in. So that just creates the challenges. With these micro CMEs, we can actually implement full auto trading filled into your account, like I said, 1 to 3 seconds. So before you even get a pop-up or a text or whatever, it literally could already be done. So that'll obviously make a big world of difference and be able to actually follow the systems, one of the systems that we teach. And a lot of you traders that trade the Apex systems, that the trades are, like I said, 10 or 20 ticks. And the micros open the door for that for the smaller account holders that we have out there. And you just, like I said, turn it on or off. If we use FX, it requires a lot larger margin. So, we've been holding off on that because a lot of people have said that they don't have the margin accounts for that. So this gives you the opportunity to have low tick value with automation. So obviously there's a lot of demand, and like I said, we've been incorporating that in. So I know that question has been out there, but I just wanted to sort of address it of what that challenge is and what are the advantages. I mean, this is from today. Okay, this is just today trading automation. Now this is trading the minis, but $436 of profit today. Now there's like probably twice as many trades that weren't even placed that were canceled. But $436 in profit today. I mean, that'd be $43.60 in micros. Well, even just 30 to 50 bucks a day adds up pretty quick. So I'm pretty excited. Like, this is the automatic logger where you go in and you can actually see all the trades placed, the entries and the exit prices and all that stuff. Any drawdown that took place, like these didn't have any drawdown, or whatever. But so we should have this available ideally for the first, second week of June is what we're working on. Obviously, that's going to go to our current Signal members. And, just as I said, liquidity, we have to keep it in check. So we don't take out the entire book, so we'll open it up. So that way you can get on, you don't have to have a computer, nothing like that. So if you have active, current, as of now, paying signals, then you'll have first crack at the micro automation when we launch those. And I'm sure they'll go pretty quick. They'll fill up, and then any that happen to be left over, we'll open it up to our other members that have our mastery courses, our elite membership, and then we'll open it up to our free members, and then of course we'll open it up to the public. So again, just try to give you updates on that. Again, after the Signal members have got access to the micros, then we'll go down the list. We're also working on other auto trading packages over the next few weeks as well. So, but just wanted to again give you an update. When they're gone type thing. Let's see here. As a reminder, again, take it to the next level. Check out our training, check out our trading tools, check out our trade rooms. We're doing ongoing education like this all the time. If you thought this was informative, just wait until you see what I teach you in like the kids trading membership, where we go into objective entries, exits, adjusting markets, advanced trainings. Again, all this on apexinvesting.com on the homepage. You can sign up, trading rooms, all that included. The integrations course, where I teach you about spreads, touch brackets, forex, futures, obviously the micros with this, psychology, money management, and of course the ultimate hedge, which is my favorite strategy that exists. And then binary trading. I teach you how to do strangles and how to go in and do different binary trades and how to actually master binary contracts. And if you want to actually finally learn how to get over yourself and master the middle mind game and master those details, like what were those lines on the chart and all that stuff that I was talking about, I go in and we break this down, me and two other traders from a live training that's recorded here. We go in and we teach you all this in the all-in market by mastery. So this sort of, are you looking for spreads and combinations? Are you looking for binaries? Are you looking for, that edge of reading the market, reading yourself? Are you looking for a very defined objective system and a trade room? Whichever one it is, it's like we have something for you. So, and then let's see here. Try to see what else we got. Yeah, we'll definitely be offering the minis as well, and other full size contracts also. This recording will be put, of course, inside the integrations page. It'll be put inside the KISS page, and it'll be put. This one will be put up on YouTube for a little while. Most of our videos we don't have out there publicly, but it'll be put out there on YouTube for a little bit for you to re-review. We'll send out a email to you with the replay link as well, so that you'll be able to access it all if you missed any, or if you want to rewatch and pick up some tips. All right, well, I hope y'all got a lot out of this tonight, and I know it was sort of long there, going on an hour and a half, but I wanted to be thorough and make sure that you understood these micro contracts, the edges, the things you need to be aware of, mistakes that are real easy to make, and help you avoid them, so that way you keep a little bit more money in your pocket. So awesome. Well, I'm glad y'all liked it. This is short at Apex World. Thanks, Grant. So, all right, you all have a fantastic evening. Have a great time in the markets, and I will see you on the next webinar. I'm sure we'll have one next week. All right? Awesome. Y'all have a good night.